Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Friday, November 14th. It's not a good sign at all when best-in-class companies are cutting revenue and/or earnings estimates in aggressive fashion. Over the course of the past few days, though, consumer electronics retailing giant Best Buy and the world's largest semiconductor company, Intel, did just that. Briefly, Best Buy said Wednesday that rapid seismic shifts in consumer behavior since mid-September have created the most difficult climate it has ever seen. As a result, the company slashed its earnings guidance for the fiscal year ending in February to a range of $2.30 to $2.90 per share, from prior guidance of $3.25 to $3.40 per share. Analysts already appeared skeptical of Best Buy's ability to match its prior earnings expectations, considering the consensus estimate stood at $3.03 ahead of Wednesday's warning. Still, if the consensus estimate came down to the midpoint of the new guidance range, we'd be talking another 14% decline in the consensus figure. As for Intel, it lowered its fourth quarter revenue outlook to $9 billion plus or minus $300 million from a prior range of somewhere between $10.1 billion to $10.9 billion that was provided less than a month ago. Intel also lowered its gross margin guidance to 55% plus or minus a couple of points from 59% plus or minus a couple of points. The limited but telling remarks provided by Intel highlighted the fact that revenue is being affected by significantly weaker demand in all geographies and all segments. Unfortunately, given their size, there is a trickle-down effect of the warnings from these industry leaders on related companies. For example, Best Buy's warning weighs on a peer company like Radio Shack and suppliers like Hewlett-Packard, which happens to use Intel processors, Electronic Arts, and Whirlpool. Intel's warning weighs on the PC makers, as well as software providers and disk drive manufacturers, to name a few. The simple connection for the market is that if these leaders' earnings are under pressure, the earnings of their peers and customers, as well as other industry leaders, probably are too. The most disconcerting aspect of the guidance provided by Best Buy and Intel is the magnitude of the revisions, as it goes to show how quickly business has deteriorated in the wake of the turmoil seen in the capital markets this fall. To be sure, it is ratcheting up the concerns about this being a very weak holiday spending season. Separately, the size of the revisions fits precisely with the market's concern we highlighted in prior commentary that analysts, while cutting consensus estimates, still haven't brought their numbers down far enough to account for the deteriorating economic environment. The market, for its part, has gotten out ahead of analysts in this respect, as the decline since the week ending September 5th has far exceeded the decline in calendar 2009 consensus earnings estimate over the same period. What estimate revisions the size of the ones provided by Best Buy and Intel do, though, is raise added concerns that the market perhaps still has not discounted the inevitable consensus estimate revisions enough. The side effects of that uncertainty are volatility and an inclination to sell into strength. I'm Pat O'Hare for Briefing.com. Thanks for listening.